Let's talk about appraisals for a moment. A lot of times people don't know the basics of an appraisal, and so I just want to talk about the importance of it when it comes to a loan, so that way you can share that with your clients should you get into that conversation about appraisals. So most loans require an appraisal to be done. So when you're talking about financing, there's two really big parts. The first part is the approval of the person borrowing the funds. Do they have the ability to borrow money and pay it back on time? And do they have secure and stable income to be able to make that payment? So that's the first part when it comes to the actual buyer. And then the second part is the appraisal, and that is on the collateral. So it depends on which loan type we're working with, FHA, USDA, conventional loans. There's a bunch of other types of programs as well. They will have different requirements inside of it, but generally speaking, the appraisal gives us an overall condition and value of the property. So we don't want our clients to pay over what the actual value is. And an appraisal is based off of typically the most recent 6 months worth of sales for homes that are in that community, usually within 1 mile radius, 6 months back. And if we don't have 3 to 4 comparable homes, also known as comps, in that 1 mile radius, sometimes we have to go a little bit further out, but we want it to be with like homes. So if the subject property, the home that your client is, say, buying, it was built in 1988, it would be really difficult to use a home that was built in 1929 or 2024. So we try to find properties, the appraiser tries to find properties that is like design and age, because there's an effective age on a property as well. Now, let's say that property in 1929 was completely renovated from roof to foundation in 2020. We're going to have a newer effective date than the original build date, right? So plumbing's been redone, foundation, electricity's been updated, new roof, all of those things. It's going to have a very new effective date. Now, there are two ways that an appraisal comes to us: as is or subject to. As is means the value that's given by that appraiser is certified based on the current condition of the home, as it is, with no major flaws or issues. If it is subject to, that means it is missing a foundational element that is required for that loan type. Let me give you an example. If we're doing an FHA loan, one of the requirements is to have smoke detectors throughout the home. If there are no smoke detectors, then it could be subject to smoke detectors being installed. It doesn't have to be the plug-in kind. It can be the battery operated type, but they have to be in the home. So go slap up a couple of the battery operated smoke detectors outside of the bedroom doors and you're fine. Let's say it's a VA loan. A VA loan requires stair rails on any stairs. So let's say there's 4 steps leading to the front door from the front of the house, but there's no stair rail, or it's loose and wobbly. That appraisal could come back as subject to a stair rail getting installed, or the stair rail being secured and stable, something along those lines. If you have a contract and the contract states the seller is going to put a new roof on the home prior to closing, but we went ahead and ordered the appraisal and that new roof isn't installed, the appraiser knows that a new roof is coming and they'll give us the value with that new roof, but subject to that new roof being put on. So that means if it's ever a subject to situation, that means that the appraiser has to go back out there, verify that that thing has been done, and they'll update the report. There are a couple of sections that talk about the quality and condition of the craftsmanship and the materials used for the home. Let me give you an example. Let's say our subject property has granite countertops, and one of the most recent closings that's going to be used as a comp, a comparable property, had laminate in the kitchen, or an original kitchen that's 30 years old and the subject property has a brand new kitchen. There's going to be some adjustments made, and they'll also talk about the condition and the quality. Typically, appraisers only use comparable homes that have recently sold. Sometimes they'll identify a property or two that might be pending just to show it as an example of how hot that market is, or kind of justifying some things, but it cannot be used, a pending sale cannot be used as a value add to the other comps. In other words, if we have 3 sold comps and the appraiser mentions another property that's pending, that pending value cannot be used towards the overall value that's used from the comparables. It can only be used to demonstrate something about that property. Maybe it's showing that, hey, this property went in 2 days. There's another property, on the other street that's a comparable. It went pending within just a couple of days too. So it just shows like how fast that market is going. But we don't have a sales price yet. If it's not closed, we cannot use it as a comparable. So if you know a great comparable is going to be closing tomorrow, wait for a day or so to order that appraisal so that comparable can be used. If the report is done, say on a Monday, and a new really solid comparable closes on Wednesday, we can't use that. It's got to be on the other side of that closing in order for it to be used. One of the questions that an appraiser has to answer is, what kind of a market is it? Is it a depreciating or declining market? Is it stable, or is it appreciating? So that's really important to underwriters when they're looking at that as well. Is it a stable market, or are things really changing quickly? And last thing I want to say about appraisals, when it comes to the loan, if it comes in lower than the contract price, and let's say seller's not budging on the price, it's kind of a take it or leave it at the contract price, even though the appraisal came in $5,000 or $10,000 less, I need for you to know that the value for the loan to value on that loan is based off of the contract price or the appraised value, whichever is less. So let me give you an example. If we have a $400,000 purchase price and the appraisal came in at $390,000, and your buyers are financing 97%, there's no wiggle room there. If they put 20% down, we could keep the loan the same, we could keep the sales price the same, and instead of it being 20% down payment, maybe in this case, I didn't do the math, but maybe in this case it's 19.5% or 19% down payment. Not a big deal in the big scheme of things. But if they're putting 3% down and they don't have any extra cash to bring towards that shortage, that could become a problem, because your buyers may be short now on funds to close, because those funds to close and the cash requirement is based off of that $390,000, not that $400,000. So you can see there's a $10,000 gap in there we've got to fulfill. And who's going to fulfill it? If the seller says no, they're not going to bring that price down to $390,000, we're going to have a little bit of a problem. So talk with your loan officer to get some more details if you feel like you might be facing that kind of situation, to figure out how to work it out to best serve your client in that situation. But overall, appraisals show the value, the condition, and it's really important as that report for the collateral for the lender to feel warm and fuzzy about that home being sold and used as collateral against that secured loan known as a mortgage.